Okay, welcome back. Thanks guys for being on again. Happy Tuesday, August 25th. This is going to kick off the kind of three statement and DCF modeling kind of course. And again, some of this is a review for some of you, but for others, maybe we'll just start from the basics. If you haven't seen the last video, kind of going over just a quick boot camp for Excel shortcuts. It's super important and super, I guess it's much better if you come into modeling knowing at least some of the basic shortcuts so that it doesn't take you hours and hours and hours just to even put in the details. So the first thing you're going to do, the group chose Chipotle, you know, a company I know and love. I eat this quite a bit. You know, it's obviously a direct-to-consumer, larger, I think, solely company store or company-owned restaurant company. Fast casual, I think they basically pioneered the fast casual concept way back when I was still in college. And the first thing you're going to want to do, I probably should, I won't use Cynthia, is go to SEC Edgar or Chipotle Investor Relations. I prefer, you guys all know, I prefer to go to Investor Relations because it's prettier. And they had the presentations here, SEC filings here, usually all nice for us. So what we want to download is the annual filings, the 10K. So I like downloading that as a PDF. And a lot of times we'll get PDFs, so let's just do PDFs. And then I'm not sure if we'll get to quarterly today, but we'll do quarterly too for today or next time. Download the PDFs. You guys obviously want to make a folder, CMG, DCF, or model. Then be organized, unlike me. Cool. So then obviously I open Excel, and hopefully you guys have Macabacus Lite. Did you guys download that, by the way? Yeah. And I saw someone actually on Rogue ask me that they asked me a question and said that they weren't allowing the Macabacus Lite downloads anymore. So I found it in my archives and I uploaded it to ROIC. So I'll keep it up there until they tell me not to. So I think they realize that they can probably make more money off of it. So I don't like the grids. I know people like the grids, so I'll keep them on. What I like to do first is I Control A, and then I just I usually go this one first, or I just go number. And so just so that I don't have to do it later. This one, so. I mean, it's an easy one to use, and then you kind of just have a dummy number in here and just get it to how you want it to look. Because, you know, when you have numbers on here already later, it kind of confuses things. So obviously we're going to start with a three-statement model, right? So the first thing you want to do is the three statements. Income statement, balance sheet, cash flow statement. A lot of filings have the balance sheet first, but as investors, I mean, I usually almost always see the income statement come first in DCFs just because that's where the cash flow is generated. So, you know, that's why we usually do that. And there's a typo already. And obviously save this. I'm going to save it. Model, you want to date it, 8/25/2020. And then, cool. So now we're kind of all set up. And the first thing we want to do is fill in our numbers, right? So from what I taught you, right, it's, or, you know, usually do this. And obviously it doesn't copy perfectly, so you're gonna have to. And so this says restaurant operating costs X depreciation amortization. And that means that they split it out below separately, which is really nice for us because we always manually have to do that, but here it's really simple. And forgot if it was you, William, who taught me that indent formula. Yeah, who was? Okay, so now that we have that, a lot of times actually you don't want to fix these until later. Kind of forgot that. So and you don't want to fix them till later because they all kind of copy the same. So just remember that we have this is the cue. I'm sorry. Same beverage, operating, DNA, pre-operating, gripping, and okay. So you want to copy these down. And just remember that financials are usually reported kind of backwards. So most recent first, and then the furthest back on the right. But we're usually projecting left to right, since that's how we read. So let's see, get this to be general, bold. This is going to be fiscal year 17, December, yeah. Equals EO month. That's a nice one. So that means that it will pop it forward or backwards by a month. So you kind of reference the cell you want. So equals EO month. And it means equals end of month, comma, I go 12. So, and again, I apologize if they've added more fancier shortcuts. And then kind of answer Dee's question from last week, formatting. We want to be formatting as we go through this. So revenue costs. So I personally like kind of going like this, just kind of holding things. And then, so you'll see that some of these hard codes are actually just summations of the others, right? Crazy. Oh, no, that's separate, huh? Here. operating, you got food and beverage, labor, occupancy, other operating plus G&A. Okay, so here it is. These are corporate, right? And these are like four wall costs. So that's why they're saying these are like operating costs. So the way that I would think about it would be, okay, so you got stores, right? Then down here you have kind of like sales minus food and food costs, right? Equals, or like food costs plus packaging costs equals gross profit, like generally, right? So that's, so in the retail or restaurant industries, they kind of call it four wall margins and four wall, like they make reference to four wall or same store kind of, or store level economics. And so that's what I'm driving here. So you have sales at the store level, right? Minus the direct food and packaging costs. So the way I put this here, and this is kind of like four wall gross profit, because if I don't buy something, they don't have to give me food, which is generally probably frozen, and they don't need to use the boxes and the aluminum foil and all that stuff in the store, right? So these are kind of direct costs that are really correlated directly, variably with sales. And then you have store level fixed costs, right? So there's going to be variable costs. Then you got fixed, like store. These are fixed, somewhat fixed, right? So you can always fire people, but generally there's a minimum number of people that need to be standing around within a restaurant or a retail store, just to like open up the store and like be able to cook the food and be able to dish out the food and be able to ring you up on the cash register and be able to like clean up the tables, right? Regardless of if there's one person that comes in or like 300 people come in a lunchtime, right? So that's an expense. And then I'll use this as whiteboard. And then after all these kind of, and then you have obviously, so under this is going to be like labor-ish, right? You can like, you'll need to hire more people per, like for a busier location and less for a less busy, but at a certain point, this is kind of fixed. And then obviously what's really fixed is rent. And then just other things, right? Like utilities, stuff like that. So, and then you have like four wall EBITDA. So I haven't got one of these companies in a while, but I'm sure if we go into just like Google this, if you're kind of, so this is just kind of, that's like the concept. And then you have like the parent co that owns all of them, right? And then you're gonna have like corporate G&A. So up here. So hopefully that makes sense to you all, right? For this specific type of business. And this is the reason why doing more and more types of businesses, like I haven't looked at a retailer in forever, but I have looked at retailers and restaurants in the past, and certain business models work like certain business models, and this does not work like a B2B software company. So anyway, but the reason why I'm spending time on this is because you don't want to waste time building a DCF in a way that, like, I wouldn't build this DCF out the way that I would like an insurance company or a software company or a manufacturer, right? If this is like a specific type of business, and that's why they report their financials this way. So I would, like, we'll do this later, but so again, you can go as far out on the historicals as you want to, but the way I like to do things is just kind of build out this 3-year historicals first annually, and then we can add on to there later. But again, these are all independent, so we want to make blue. I'm going to make these blue. And we probably want to add all these up. I just want to see if this is. Yep, this is the same number. But as you saw, we don't want to treat corporate costs the same as unit level costs, right? Because they're just different drivers. So what I would do actually is total unit level expenses, or restaurant level. And sum these up. And you want them, so all equals gets you the sum real quickly. But you kind of just remember, you always want to go comma and don't want to do that because we're going to be building out the assumptions here and like inserting rows, right? And so if I just did, that, enter, right? And then I started putting in assumptions like equals this, or like growth metrics, then it's going to change the summation. So that's why we want to do it individually. I personally like doing this, but you can order it too. And again, a lot of these things are stylistic, so just remember that, you know, some things that I say don't always go. And just listen to the style. And again, guys, just shout out any questions along the way. Some of this is minutia. I know I'm fast, but you guys are gonna be waiting still. So that's interesting. So they have pre-opening costs and then impairment and closure costs. So conceptually, these are, and again, we would want to read the footnotes. Obviously, before I ever do a DCF, before I touch anything, I always read the full 10K, and I always read the full like transcripts and the latest, like any brush up on the latest Q, just to understand the business. Because before you do you want to understand the business before you do the DCF. But my understanding of what pre-opening costs are is if you open up a new store, you have to like train a bunch of people, like hire them, train them, and there's more costs up front. So I could like, yes, they're like on an accounting basis. These pre-opening costs are expenses, but they're actually kind of CapEx. Like you spend, like they're part of the upfront CapEx on the ROI equation for them, right? Because every time, I hope they do this, every time a big corporation, whether it's a restaurant or retail, that's like unit based or restaurant based, every time they open up a new location, they do kind of an ROI and payback period analysis on it. And then, you know, they have to lump in all these assumptions, like how much money is it going to take to build these things out, and what are the pre-opening costs? Like the build out, the pre-opening costs are conceptually more like the build out costs. And if they open 0 new locations, this probably goes to relatively 0, right? And then similarly, if you're not closing stores, I'm gonna call them stores or restaurants, or whatever, if you're not closing them, then you won't have closure costs, right? So I really like doing this. Okay, so what I would say is I'm gonna split this out. I mean, this is all stylistic too. Total like corporate expenses. Total like growth, closure, expenses. Yeah.
total expenses. Same for double check. 4205, 4606, 5142. Okay, good. And then these are just income from loss. So this is bit. Interest, other income, income loss before income taxes. So it's EBT. This is, you know, are there any questions with how, because some of you haven't even taken accounting 101. Are there any questions about how an income statement works? Revenue minus all these expenses equals EBIT. And those are like the operating expenses minus interest expense. So if they have debt out there, they have to pay interest, right? Whether it's financial or like unit level. And then taxes on the profits that they earn. I will say one thing to look out for is a lot of times this will be like everything here will be positive numbers. And so that implies that revenue minus all these equal this number, right? But then for some reason they flip that and they make the income tax number, or they flip it below EBIT. Below EBT, they usually flip. A lot of times they'll flip income taxes to negative, and then it'll be this plus, like, it'll mean still subtract this. So just remember, like, this is a common mistake. So sometimes, like, if people are modeling and then saying that, oh, EBIT, so this is black, so we want to make it black, equals this minus this, right? So just Control Z, Control Y, Control Z, Control Y. Make sure that it's right, right? So they'll do this, and then they'll kind of like mindlessly do this minus this. And you just want to make sure that's right, right? So it's not right, because this positive number actually should be added. So just like be aware of that. So then it's really an add, not a subtract. And I never really actually looked into why they did that. So just double checking the numbers: 458, 268, 275. One thing I remember I learned in my like training session when I was an intern is never hard code. You always want to copy and paste. The thought behind that is you'll always make mistakes. Hard coding, hard coding. Now we have the income statement done. Revenue minus operating expenses. Equals EBIT minus interest expense or income. Like this is interest income. I don't know where that comes from. We'd have to read the footnotes. And then minus taxes equals that. Is net income. Cool. And then we can add metrics later. So usually I just want to build out how these things relate to each other. Right? So balance sheet. So the balance sheet. We're doing annuals first, obviously. Just reminding you all. So copy and paste this. I'm going to copy all the way down to total liabilities. I don't like titles. I don't like making my models any longer than they have to be. Okay, so let's just copy that down. So remember, it's backwards, right? 19th first. So, oh, sorry, I like locking up here we want to freeze panes and freeze panes here so that we know what year we're in, wherever we are on the sheet. And we know what we're labeling this stuff as too. Okay. So we're in the 2019 year. Obviously that needs some work. And then we want to line this up. So cash, accounts receivable, inventory, prepaid, income taxes, investments, this. Okay. We're good until this. It skips 2 lines because these are titles. I already did that. I forgot about your new all H6. How muscle memory works. You guys all know how the balance sheet works generally. So, I don't know how much I have to go over this. 3, 4. Okay, so we. Yeah. Another thing. And so this is weird, right? So commitment and contingencies is on here. I don't know if it's a title or it doesn't look like a title, but it looks like there's nothing here. So you want to go to note 13. I mean, I'm just curious. What does note 13 say? Purchase obligations, short-term nature. Okay, so there's like nothing on there. Just ignore it now. And again, for those of you looking at international stocks, IFRS is going to work a little different sometimes. So just be aware of that. So the way the balance sheet works, right? On one hand, we have assets equals liabilities plus equity, right? Equity, right? Super. So just this section will equal liabilities plus the equity section. And so I'll put in equity stuff just to make sure that it's okay. So there's a lot here, right? Clearly there's like a couple classes of stock. There's common stock, there's preferred stock, additional paid-in capital, treasury stock, and retained earnings. So you guys are all taking accounting 101, hopefully, if you haven't already. And each one of these things is kind of its own topic, and obviously has like accounting concepts tied to them. A lot of these are like book value of equity, right? Paid in capital generally is like capital raised, I guess raised for the business, like kind of on the front end. And then retained earnings are like any excess net income you have goes into retained earnings. But most DCFs or three statement models I've seen either have just like lump all these into one, or they go just like, I guess, equity and paid in, and then retained earnings. Then you can go like total equity, and then get another line of total liabilities plus equity. And then basically the formula we just wrote equals assets minus total liabilities plus equity needs to equal 0. And that's our like balance check, and you guys always want that balance check. So obviously it's not balanced yet because we haven't put an equity. So we'll put an equity. I'm just gonna lump all these other things in. I'm just gonna lump it into one. So what I just did there is I just copied them all down, summed them up, and I'm going to copy them as a value into equity. I'll do that here too.
I had a question.
Yep. Yeah.
So just like how you lump stuff together for the equity section,
yes.
Would that ever be like a good idea for other sections? Like I know that sometimes there are some like random like line items that really like it's hard to project, or just are really immaterial. So would it ever make sense to do it then? Like maybe like a liability or asset?
Yeah, I mean, we'll get there. There are definitely things that you might want to lump in, but I usually do it after the fact, if that makes sense. So we'll do it after the fact.
Okay.
Like off the top of my head, I usually lump in cash and marketable securities if they have them, or like short-term securities because they're cash-like and they're kind of used like cash. They're like certificate of deposits and stuff. Other than that, I don't like nothing off the top of my head. But if there are, we'll run into them while we do this. Let's finish this. Assets or liabilities plus. But yeah, like to your point, usually equity is lumped in, and that's what I've always seen. Like to the point where if you ask me to like explain in detail how each of these accounts work, like I would have to brush up on it because I haven't taken the actual accounting courses in a while. Anyway, so we're balanced, right? So obviously we're balanced because these are hard code numbers. Does this look good? Everything so it doesn't flow. Again, always just be careful. It's better to do it up front. All this manually. So you guys see what I'm doing? Control Z, Control Y, and then looking at the cell. If it doesn't change, that means that I did it right. And I didn't do it right. Okay. We want to make sure this flows because I'll show you what we're going to do later.
So we're starting out with an annual. I know I keep saying that, but I just need to make sure that everyone knows. Cash flow statement.
So all these things: cash flow, net income.
Yeah, I mean, this is an example where I usually on a DCF will lump a bunch of stuff in. And to be honest, like I was at a very, multi-billion-dollar hedge fund where we never actually did three-statement models because at a certain point we would lump in what net working capital is and just project net working capital going forward. But three-statement models are kind of the core to understanding how it all works and how it all fits together. And obviously, if you guys go the private equity route, that's where you see a bunch of three-statement models, a lot more so than, hedge funds sometimes just skip that step. Everything in a private equity fund, all the analysis is usually just a lot more detailed, just because if you buy a full company, you get all of their financials. Like you get kind of the data room that has detailed buildups of each of these accounts, versus if you're a public market investor, you don't get all that. If that makes sense? Like you just get these filings, and that's all you have to work with.
You guys know how that works, right? I'll just explain it. Okay. Something was up. Formatting. That was just formatting. I feel like I copied this wrong. Wrong. Okay. So these are all blue. Any questions about what I'm doing?
Yes. So why, I mean, is it normal to include like historical cash flow statement? Because I mean, isn't the projection just going to be like the pretty much just the changes in the balance sheet?
Yes, that's true. But you'll want to understand what so a lot of times depreciation and amortization is not split out on the income statement. So there are key items here that you'll want to see historicals of just to see and drive them from here. Does that make sense? So a lot of times you'll see PP&E driven from here, right? Because PP&E is not on the income statement and you don't drive it. You don't usually drive change in PP&E because change in PP&E has two things in the equation. It's net additions and then minus depreciation and amortization, right? So yeah, so there's a usually you'll want to put in historicals just because some things. But again, like a lot of these things could be, I think you're right, like can be combined. I don't really see why you wouldn't do it. Like, if you're speed modeling, then yeah, like I guess just cut out everything you can. But usually people like to see 3 years of historicals. And then if this was all blank, I like if I got that in an interview, I'd probably be like, why didn't you put in historical cash flow statements? Because if I deleted this, let me show you. If I deleted this, and then you just had PP&E or CapEx, like projected forward, like 500K forward, and then but you didn't have any of this, I'd be like, how do you know this? Like, how would you know, what frame of reference do you have that 500K for CapEx is reasonable, right? So
Okay, that makes sense.
Again, I know you guys are like waiting and just watching me put in numbers, but we'll get to like the meat of it pretty soon here. I know we're already cutting it like 40 minutes. So. So the net change in cash is the summation of net cash provided by operating activities, net cash used in investing activities, net cash used in financing activities, and then obviously there's like some FX, and so I know there's portfolios in the UK and stuff. So foreign currency moves around. Okay, so that's all built, right? And so from here we have historical financials, and then now we can start working. So this is like historicals. And then now you want to work on kind of projections. We're doing a 10-year model. So kind of continue this on. And your DCF. And then so now we kind of want, now we can kind of play with this stuff, right? So the skeleton of your projections, you're gonna paste forward a lot of the summations that you did, right? So that's why formatting along the way helps, because I right now I know visually the black numbers are some things that I can like copy forward. And then
Should add some music. I have to start humming. Okay, so now let's go one by one. So now we start projecting. I mean, like it's pretty simple. It's that simple. So revenue, how do we project? Usually growth. And I won't explain all the things I'm doing formatting wise because formatting is stylistic. So you'll just see what I'm doing. So now, see, we see here now divided by 1. And then, okay, so a little tidbit formatting wise, when you use like numbers, there's always an indent on the right. And so when you like have your own percentages, you always want to like go to custom and then underscore close parentheses, puts that indent in there. And that gives you room for it gives you room for, so the first number before the semicolon is what the format will be in the positives. The second after the semicolon will be what that formula will be in the negatives. And then the third will be what it'll be like when it's 0. And I just usually like dashes because they're cleaner. So you'll see there's an indent and it's aligned. Just that line. That's stuff you learn in banking, but some of you might skip banking. Lucky for you. So obviously we're going to start hard coding things. So the formatting I like is this like dotted line and then make it blue, obviously. Blue is hard codes. I usually like non-financial numbers as italics. So again, the end goal is actually not to drive this thing through just growth, because in reality, we're going to have a full like operating model where we're going to be like tracking number of stores and like openings, closings, and then we'll have like net adds, right? And then so we'll have number of stores beginning a period, and then we'll have number of stores end of period. And then for each new store, right, we can drive capital expenditures because, right, for new stores, they have to go build out like the classic Chipotle look and the stoves and all that stuff. It'll have, for every new store, there will be pre-opening costs. And for every closure, there will be impairment and closure costs, right? So we're going to build a really simple DCF first, but you would kind of like, it's the most simple speed DCF, and in the industry and just generally, like most of these models are driven by the actual unit economics. So like not just percentages. The percentages is how you learn how the accounting works. And then the rest is kind of like business model analysis. So anyway, now let's just put in 15%. And then we'll do quarterly later. I realize it. So equals, right? So the formula for growth equals previous year times 1 plus the growth rate. So what I did there, just for speed, is a lot of times if there's like a row, I'll snap to the end where I can, put an X. So a lot of times I'll just like put an X to just make sure I have a wall so I can kind of pop to and from, right? Because if I didn't have this, I'll pop to the end of the sheet. So it's not a bad idea to do this throughout the whole thing.
but I'm just going to do it as we go.
Food and beverage and packing. So just let's think about the business model, right? Food and beverage and packing is a direct expense. It's variable with how much revenue we get. So it's a percentage of revenue, right? For every burrito they sell, they have some direct profit margin on that burrito. So we see that, you know, when we pay $10 for a burrito, they only keep $3.30 per burrito, right? And then you want to drive it as revenue times that. But it's actually 33%, which says steady gross margins. So like this revenue minus food, beverage, and packaging, I would say is like your true burrito gross profit. But I'm not going to. Labor, over time, I'll probably drive labor as dollars per store, because I'll just assume that each store requires like, I don't know, 10 staff, an average of 10 staff paid at like, I don't know, $10 an hour, right? So and then they all have the same store hours. So that's how I would drive it. But for now, actually, let's do that right now. But otherwise, you can't really drive it. I'm going to find a table that says number of restaurants. Okay, so here, see, I didn't even. Oh, they've got other things like Pizzeria Locale, Tasty Made and Shop. I've never heard of that. See, they even do what I just said. Openings, closures, relocations, total restaurants at end of period. I have analyzed restaurants in the past. Told you guys about how I hated Shake Shack when they IPO'd, right? So in restaurants, there's a concept called same store growth and like new location growth. And when you see growth here, the nominal growth number hides what's actually happening. What we really care about is same store growth, meaning if you didn't open up a single additional restaurant, is revenue growing per store? Like if you only had one store, is the revenues per that store growing, right? Are there more people coming in the door, or are you raising prices? That's what we call same store growth, or kind of four wall growth within unit level growth, right? It's called same store sales. And then inorganic sort of is, you can add a bunch of restaurants and you'll see a bunch of growth, but it might not be a good idea if you're adding restaurants and those restaurants aren't doing very well. But it'll still add revenue growth because you just add straight up revenue. Cool. So labor, I'm going to drive this as, labor per store. So they really only have 2,400 store restaurants. That doesn't sound right. I thought they would have more. Does that surprise you guys? No? Crazy. See, they do average restaurant sales, comparable restaurant sales. Comparable restaurant sales and same store sales are about the same thing. That's why they report it separately, because it's so important. See, okay, so in the filing, when you read these things, you really, you'll really understand, like when you read it, you'll understand the business much more because they explain it to you. So they're driving labor costs as a percentage of revenues, but I would say what's more likely is some average per. So what I would call this is annual labor spend per restaurant
per year, right? I believe this is in thousands. Yeah, thousands. Okay. All right, so that's that. And then I would say, okay, so here we see this metric shows us that. Well, so here's an interesting thing. So
if I want to find annual labor spend per restaurant for the year 2018, they did, this is the end of the year period, right? So at the end of the year with 79, 83 more restaurants than they did at the beginning of the year, right? So what we need to do is take the average. So it's the labor spend divided by the average of the numbers of stores they had, restaurants over the period. Okay. So we know that they spent, like, wage increases generally, wage or required people that they had to pay at the stores per store grew 6.4%, right? And yeah, like I do like their metric because it's like a nominal metric. It's labor as a percentage of revenue. We should do that too here. And then we should probably lock these so that we can reuse this. So what I did was I locked the bottom one only on the rows. So yeah, I'll just assume you know the Excel basics. Right, so this one increased here, and you won't really know why unless we project it back, right? This doesn't really tell me much, like this increased, but why did it increase? But this tells me a lot. It tells me they spent more per restaurant. You know, I don't know why. Occupancy is kind of the same thing. So growth in occupancy is rent, right? So if I want to project kind of the same thing, right? Yeah, I mean, I guess you can say as a percentage of revenues it's going down, but this doesn't really tell us much, right? It's going down. Why is it going down? I don't know. So annual rent spend per restaurant. So occupancy divided by number of stores, or well, average over the period. A lot more guesswork, educated guesswork in kind of public market investing. Because if you got this in a data room and you were LBOing, leverage buyouting a private company, they give you like the full rent schedule. You would see exactly what the rent was per location. And you would see exactly what the labor costs per location are. So you don't need to guess at this, but all this work I'm showing you is like more from a hedge fund perspective, public hedge fund perspective, that like, I'm driving like this because I know that we want to be more granular than just these nominal numbers, but how do you become more granular if they don't tell you? You just have to kind of like make these very analytical, like second order and third order thinking steps. So this one, I'll just go percentage of revenue just to say. Well, sure. So here we see they spend 142,000 per location. So here's what I'm saying. Revenue, same store sales growth. So rent doesn't change, but your sales can increase per location, which would make it fall as a percentage of revenues, right? But you don't understand it unless you break it out using this metric here. And these are all going to be very different per company. And here we see there's these random operating costs, which we can, the footnotes will tell us what that is. Okay, and okay, we'll stop
we'll stop after we finish the income statement. Just be part one. So here I'm gonna say growth in labor spend, wage growth. I mean, wage growth is probably going to keep going, right? That means you drive this plus the growth rate. So because I'm growing wage growth per store, meaning people are going to ask for 5% wage increases, or just the kind of minimum wage or $10 an hour market is going to grow at 5% a year, right? That's a much more analytical way of driving this thing, right? And so when I'm doing that, I don't just, this number actually becomes annual labor spend per restaurant times the average number of restaurants in that period. See that? So starting and then. So number of stores, let's just say they just increase their store count by 5%. You guys can already tell, right? The majority of the time spent on a DCF is not actually this like hooking up stuff. It's up here because this is where the business is. I know I do need to teach you guys how to hook this up though. So I'm going to project this forward for now, and then we can fix these later on. The depreciation and amortization as a percentage of revenues, just keep it at 3.8 for now. G&A, which have it grow as a growth rate. It's going really fast. Okay, that's weird. I don't know why that's growing so fast. Okay, let's just do it as percentage of revenues too. That alone, because that'll be per new opening. This will be per closing, right? Leave that alone. Total operating EBIT, interest income. I don't really know what that is. We'll have to go to the I have to look into that. For now, let's just assume it's a percentage of revenues too. It's kind of safe to assume if you don't know how to drive something, just do it as a percentage of revenues. Because as a business grows, whatever they're going to do is, you know, it might be actually as a percentage of cash that you earn interest on the cash you have. And then you also want to look at the historicals. Like, it doesn't really make a lot of sense. I'm just going to do this percentage of revenues. Taxes.
And taxes are a percentage of earnings before taxes.
Tax rate. I don't know why.
Oh, yeah, there's a tax bill, right?
Okay. So what I did there, I know that was fast rushing towards the end.
We have revenue driven by growth. Food and beverage is right now driven as a percentage of revenues. Labor is driven as, for now, or like we'll get into this, but we're projecting labor as a percentage of, as a store level thing, right? How much labor do you have per store? Occupancy is how much rent do you have per store. So let me just finish this out if you guys have a few more minutes. So we're going to say, how much does rent grow? I mean, not much, right? Because rent usually stays the same or has like some nominal escalators. And then what we do is we kind of do the same thing here. And I usually lock these things. So what I'm doing is average rent spend per restaurant times the average number of restaurants. We're driving this. Other operating costs. I'm just going to grow this as like kind of the same as labor. I don't really know what this is yet. Including leasing costs and labor, distribution. Our operating costs include, among other items, marketing and promotional costs, bank and credit card processing fees, restaurant utilities and maintenance costs, and delivery expenses. So I'm actually going to do this one as a percentage of revenues because that's interesting, right? We're probably going to be spending more in delivery costs as we become more delivery oriented, right? So we're going to have to load that onto the business at some point. So I'm going to leave this on as other operating costs as a percentage of revenues. So just keep that the same for now. Total corporate expenses, right? Pre-opening costs. You guys want to finish it up? Take 5 more minutes. Yeah, we'll do it. We'll do it next time. So that's how we drove. So we drove general and admin as a percentage of revenues. They should kind of top out at some point. Like, how much can you spend on a corporate headquarters, right? Otherwise, you'll get activist investors saying you guys are spending way too much money down here. And then depreciation and amortization, which I'm going to do as a percentage of revenues for now, but conceptually actually should be done off of like useful life of PP&E. If you guys understand the accounting. And so here, but again, this is actually just the same thing we did on the front end of this model. It just looks more complicated now because we added a bunch of like KPI analysis, like as a percentage of revenue or per restaurant, and then we'd have these projections going forward. But it's the same income statement. You know, nothing's changed. But here, hopefully you guys understand the importance of like when you sum, like do it individually, because I clearly inserted a bunch of stuff and that. Cool. Thanks guys, this is part 1. I'm gonna stop it and take some private questions and see you guys later.